As a market, we're really undercapitalized. The way we measure it, we sit somewhere between 1.5 years of dry powder at a point in time. When you have a year like last year where you've got $240 billion of volume, you soak up a lot of that, and we happen to be in a very hard fundraising environment. We need that flywheel to start spinning again for, I think, the market to grow.
Thanks everyone for joining. Really exciting panel today. Thank you first to iConnections. My name is Ian Brown Christensen. I'm a director at CAS Investments and a member of our investment strategies team. Today we're joined by some very interesting, unique perspectives in the secondary space, and we're excited to chat about it. We only have 30 minutes today, so what we're gonna do is we're gonna do brief intros, we're gonna do a little bit of background, more macro related, and then we're gonna dig in, provide some individual perspectives. Why don't we start with you, Alexis, a bit of background on yourself.
Sure. Can you hear me well? Yeah. So I'm Alexis Ferrer. I'm a partner at BEX Capital. BEX Capital is a secondary investment firm. We have a bit more than 2 billion of AUM. We're also a Sagard partner. Sagard is a global alternative platform with over 45 billion of AUM. What's specific about BEX is we're pretty unique as a secondary buyer. We only buy LP interest in fund of funds, secondary funds, and co-investment funds. We've been doing that since 2010 and through commingled funds since 2016. We're currently investing our fund number 5, and that fund is just shy of $800 million.
Yeah, my name is Mike Forstner. I'm CIO for private markets for Mercer. We've been investing in secondary funds, such as Lexington Partners, since 2004, and we've been executing on secondaries ourselves since 2012.
Taylor Robinson, partner on the investment side at Lexington Partners, have been with the firm a little over 18 years now. Lexington as a firm, we've been around 35 years. One of the, I would say, early kind of pioneers of this secondary market for private equity. We're about $90 billion today. We sit across 10 offices. We're 225 people, and we sort of do really only 2 things as a firm. We do secondary private equity, about 85% of our capital, and then private equity co-investments, about 15% of our capital. And so, and then within secondary, do everything. Traditional partnership deals as well as GP-led deals. So great to be here and thank you.
Hey everyone, I'm Dan Forman. I'm at a single family office here in New York, Jefferson River Capital, which is a family office for Tony James, the former Blackstone CEO and president. I've been here for 3.5 years. I help oversee our public and private investing. We have about 20 investment professionals. We pretty much do every food group and asset class out there, always trying to be opportunistic. I've been pretty active in secondaries, so excited to talk to you guys about it.
All right. Taylor, let's start with you. GP, LP, led secondaries. Just quickly, let's go through the difference between the two and the different roles they provide in terms of liquidity.
Yeah, let me just start with the service they provide for the sellers, which ultimately is just liquidity. If you think about the secondary market where it began 35-ish years ago, as people committed capital to funds, and as that capital got drawn down, but at points before the funds were entirely realized, investors needed liquidity, and that was the creation of the secondary market. So what we do as firms is underwrite the assets in a private portfolio, a fund, decide what we're willing to pay for that, and we effectively step in and become a replacement limited partner for the institution, whether it's a pension or an endowment or a foundation, you name it. Institutions historically who needed liquidity at a point before the fund sent the cash back or fully wound up. That's sort of the plain vanilla LP partnership deals as we talk about them. What has happened over the last, I would say 7 years, is real growth in what we call GP-led deals. It's a technology sort of a deal type that started going, it's more than that, it's about 20 years ago. But today, general partners, private equity firms, growth firms, venture firms have realized that there's another source of liquidity for their LPs instead of selling assets to a competitor, taking them public, selling to a strategic. They can also continue to hold those assets by doing what we call continuation fund deals. And that is where one private equity firm makes a decision on behalf of their LPs to create liquidity around one or two or three or a strip of assets and move them into a new fund capitalized by generally secondary firms. And then the proceeds from that transaction, the liquidity is offered to the investors in the original fund. And so what's happened over the years is whereas that technology was originally used for older assets, today that is being used generally for the better, more attractive assets in a portfolio because those firms are forced to invest alongside us at that price in an aligned way. So I think all of it is under the guise of providing liquidity to the original investors, but in one case it is the LP who is making the sale decision. On the other side, it is the GP, the private equity firm, who is making the decision to create liquidity for the LPs.
Mike, a bit about portfolio rebalancing, the impact that plays on your portfolios, and then where the execution risk comes in.
Yeah, I mean, the whole idea of using the secondary market for rebalancing is a relatively new one. I mean, you can see people doing any number of things. You sell off non-core assets. That is a very common thing to see in the press. Like, why did they sell? To refocus around those firms for which there's an interest in having ongoing relationships. And frankly, I think we see that in really a minority of cases where people really are using it for rebalancing. Usually you're selling an asset you don't like, which does impact the sale price in some cases, because the buyer universe knows whether those funds are any good as well. I mean, there's very little that you know as an existing LP that your secondary fund that you're going to show an asset to doesn't already know. These are well networked. These are groups that know the GPs. There's no secret that they don't know. So you're going to get efficient pricing on that, which the seller may or may not like. But it is a way of dealing with portfolios that can end up being overinvested at any given point in the cycle. And right now, I think one of the real issues we're seeing isn't that private equity hasn't generated enough distributions. It's that a lot of the vintages between 2016, et cetera, way outperformed expectations. And a lot of that excess is what's trapped. So it's really the upside that you saw from vintage years 16, 17, 18 that haven't worked their way out of portfolios that are representing a lot of the value that's getting bought. So where the remaining value to paid in our own case, so when we look at kind of a 2016 vintage, is actually still greater than a 1x. So hopefully, SpaceX will solve that.
I think there's a lot riding on SpaceX right now. You mentioned the market efficiency. I think the discount rates in the secondary space are paramount to the asset class. Dan, talk a little bit about the history of where discount rates have been. Where are they today, and where do you see them going in the future?
Yeah, sure. I think like historically, I just think of the secondary discount as 20% down. That's like your generic illiquidity premium. We're pretty active in GP-led single asset continuation vehicles, and have spent some time on multi-asset. I think multi-asset still remains pretty cheap. The single asset deals that we've seen are kind of these trophy kind of halo assets that are, when we first started doing about 3 years ago, kind of 95 to par, and it seems like now stuff is going at par plus. It has really been driven by underwriting on the asset and kind of a full LBO kind of valuation standpoint. Not that we need to kind of get it at a discount and then mark it up to 1-2, which was like kind of the historical trade. I would say though, there's some technology and structure in these assets that are growing. You have delays in closing and the momentum of the deals. You're still getting pretty good discounts on an LTM basis when they actually close, because we're really investing behind a lot of growth. So I still think regardless, you're still kind of getting this 20% discount, but on a NAV basis, I do think the market is sort of going away from pricing a discount and like really underwriting asset by asset. and the growth and the delay in the closing and the reference dates are still pretty attractive. But I still think it's a 20% market.
Yeah, and the secondary space, it's grown so much over the past few years. That's news to absolutely nobody in this room. But it still only represents a small portion of investor portfolios. Alexis, how much of the growth of secondaries turns over each year? Where does it go from here? And how is that impacted by the M&A drought that's occurring right now?
Yeah, so if you look at the numbers in 2025, so secondary volumes, it was about $220 to $240 billion. And you compare that to the AUM of private equity as an asset class, that's about 8 trillion-ish. And so you get to a rotation rate that's about 3%. Now, that number of 3% is increasing, but it's still pretty low. If you compare it to more mature markets, it wouldn't be surprising to see that number grow to like 5%, maybe even more than that. The question is also, we've been in a liquidity environment that's been kind of challenging over the last 3 years. The average industry distribution rate was about 25% of NAV. Historically, it's dropped to kind of half of that recently. And so question is, as we see liquidity come back, is that going to change the dynamics in the secondary market, and are we going to see volumes actually decrease because of that? Natural liquidity coming back. And I think a good way to look at this is to look at the past, and especially 2021. This year, 2021 was very interesting because the M&A market, the IPO market were doing really well. They were like at an all-time high. And if you look at the secondary volumes now in 2021, it was also at an all-time high. So what that means is that there's no real correlation between the lack of liquidity and the volumes in the secondary market. It basically means that secondaries is not just a one-off tool that's being used in a stressed environment. It's more, it's become a management, portfolio management tool that's available to both LPs and GPs, and it's here to stay. And my personal opinion is that going back to that rotation rate, that 3% is, going to increase. If you look at the numbers, the market has kind of doubled every 5 years for the past, 10, 15 years. It wouldn't be surprising to see the overall volumes in the secondary market double again in the next 5 years and reach maybe 500 billion. Wouldn't be a surprise to me.
Do you think that it's more, one of the shifts is that GPs will become more reliant on the secondary market for an exit compared to where they are today? I'll open this up for anyone.
Yeah. Absolutely.
Yes.
Yeah,
I'll agree.
Okay. I think I saw the stats. I think 40% of sponsor-backed exit activities now come from single asset or GP-led activity, which is just crazy. And to piggyback on Alexis's comment, I think I saw these stats. 10 years ago, the volume was on the GP-led side was 8 billion. I think in 2025 it was 108 billion. I think a large amount of these deals are now over $1 billion. So I think the scale of this is at an unprecedented growth rate. So it's pretty exciting.
Yeah, I mean, I would just make one point. I think it's all circular in the sense that this market needs distribution activity off these portfolios for reinvestment into the asset class. And if you think about the secondary market and you sort of look way back in time, it hasn't grown in a linear way. It's grown in sort of a step function where every time there are new sources of capital to the market, it grows. And so, we need those distributions to come back to see that next step function in terms of the size of our market. As a market, we're really undercapitalized. I mean, the way we measure it, we sit somewhere between 1.5 years of dry powder at a point in time when you have a year like last year where you've got $240 billion of volume, you soak up a lot of that, and we happen to be in a very hard fundraising environment. And so we need that flywheel to start spinning again for I think the market to grow. If the thing that has been happening is if you as allocators, some of you in the room, had a mature portfolio of private equity in the years leading up to 2022, you were enjoying a cash yield off your portfolio of something like 20 to 25% per year. And over the last 4.5 years, you've been down at 10%, 12%. And so significant reduction in the liquidity, but during that time, the NAVs in the portfolios, because of performance of the assets, have been increasing. So actually the issue of trapped NAV is getting bigger faster than the sources of liquidity. That is, and then what we see because of it is better and better assets with longer durations squeezing their way towards this secondary market. So I think that's the thing that's really exciting for us. That's sort of a winding, like.
Do you have a spot where you think yields will normalize, distribution yields will normalize?
I don't think they ever get back to 25%. I mean, to get back to the same dollar quantum of distribution we saw in 2022, which was the peak, based on the NAV today, that only gets you back to about 13% distribution yield. So you need twice as much liquidity in the market as there was at its peak to get back to 25%. So that's our view. I mean,
the IPO market's been kind of on the sidelines, though, for a while for buyout-backed companies,
right.
In particular,
right.
Which used to be a viable kind of channel, especially you look at the upper middle market to larger funds. Being able to IPO a company was a relatively normal thing. It's now a rarity. I think if that liquidity comes back into the market, it also provides competition for assets that otherwise would come from larger buyout funds, that otherwise would come from strategics. So you've kind of lost both somebody who was a mechanism that was great for testing price, for providing liquidity in otherwise fairly boring businesses, very standard kind of ones. And I think it would also be very useful if we got back to that in terms of how do you get to the overall market to a place where it's generating sufficient liquidity.
Yeah. Speaking of looking ahead at the next 10 years or so, Taylor, how do you see, you have a front row seat at Lexington. How do you see the competitive landscape, just the overall market dynamics? How do you see all that shifting over this next market cycle?
I'll break it into two sides. If you look at the LP partnership side of our business, there are very few new firms that do that. It's all the same names that were around 10, 15, 20, 30, in some cases 35 years. There's a real benefit to scale. There is, over time you build a very broad set of relationships and information, and all of that benefits the investors. So I think that the LP traditional secondary partnership deal side, it doesn't feel more competitive. It's just the same people getting bigger and bigger. And there are some acquisitions and some combinations and things that go on. And on the GP-led side of the business, where private equity firms globally are waking up and they're saying, there is a fourth way to create liquidity. Yes, you have family offices. There are definitely new entrants, but that is a market that really needs capital to continue to grow. And there is space for lead investors and then a whole tail of syndicate investors in all of these deals. And this market is always creating new assets. I joke with people sometimes that we talk about in that market that private equity firms are selling their favorite asset. Well, at some point they run out of their favorite asset, and then there's the next favorite asset. But the point is there are always new deals where at year 5 or 6 or at some point in their value creation curve need liquidity for the LPs. And so lots of new entrants there. But again, it goes back to a market that's really capital constrained, where on the partnership side, we, Lexington, can buy what we want, and BEX can buy from the same seller as part of the same deal what they want and not directly compete.
Right.
You're creating a solution on the GP-led side where it's one asset. It doesn't feel hyper-competitive because there are so many companies and so many firms and so many funds.
And
Yet. It doesn't feel competitive yet.
And you also have the rise of these more asset class-based secondary strategies. Alexis, talk about that real quick. Your thoughts on how, as the next evolution of secondaries, you have the rise of asset class specific. What do you see in the space? What looks best to you? What don't you like?
Yeah, so I think maybe one interesting trend, like as the overall market is getting more sophisticated, both on the GP side and LP side, we're seeing maybe more specialists coming into the secondary strategy. It started a long time ago with GP-leds. That was kind of something new, right? Initially the secondary market was just LP-led. But then more recently, we've seen, credit secondary funds becoming larger and larger, and this is kind of fueling the entire volumes within the secondary market. We are also seeing energy secondary funds, real estate secondary funds. Even the strategy of BEX, it's kind of unique, right? If you think about it, if there was like 100 million in a fund of fund for sale 10 years ago, it would have been challenging to find a buyer for that. Today, it's something that's possible.
Yeah, and if we drill down even further, you start to get to the single asset CVs. And we have a family office as an allocator that can speak to it. We also have Lexington that can speak to it. Dan, we'll start with you. Your take on single asset CVs, how you see the space right now.
Yeah, I guess the only thing to add to Alexis on innovation, I do think we didn't talk about venture yet. I think as tough as the kind of 19 to 22 vintage private equity, I think venture is arguably worse. Peak valuations, interest rates, IPO market shutting, SaaS, AI, that was AI under in. So I think there's some pretty clever new entrants in the venture community, especially on the late stage stuff, as people still have these huge NAV moves, over-allocated venture, no DPI. So I think venture is also a pretty interesting asset class to do secondaries in. On single asset CV, I didn't even know what it was. We try to invest in funds and do co-invest. I think at the same time as kind of the M&A and new deal flow on primary side is slow, all of a sudden our GPs kept calling us. They're like, hey, I know you want to do co-invest, but running a CV, Lexington is leading it. We've got $100 million in a syndicate. You should take a look at it. So it's kind of a combination of a co-invest and a secondary buy at the same time. So it's now been a huge kind of tailwind for us. We've probably done 20 or 25 over the last 3 years, and we've probably only done 5 or 6 co-invests. So the ratio of co-invest to single asset CV kind of came out of nowhere, and it's kind of it's been a golden era for us.
Yeah. Anything you wanted to add there, Taylor?
No, I think all of that's correct. I think what you're seeing is the natural maturation of an asset class that is growing, where firms begin to specialize and offer specialized products. And I would just maybe take a little bit of a different tact, which is, for all of this market's history, people have thought about secondary as this highly diversified portfolios with a very narrow bandwidth of returns. And so that expectation, what people have seen historically, will probably look different prospectively as firms specialize. And so 5-10 years from now, you're going to look back and there will be single asset funds and credit funds and partnership-focused funds and tail-end funds and newer secondary funds and European. So it's just the market is broadening out.
Yeah. As the market broadens out, Mike, give us 2 asset classes, some that you prefer the secondary market over its primary counterpart, and then maybe the other side, one that you really like the primary side, but the secondary side not as much.
Yeah, I think if you looked at opportunities across the space, one really interesting one for us actually is the intersection of infrastructure and private equity. On assets that are either accumulated or companies that are grown with the cost of capital from a private equity firm, eventually sold to an infrastructure buyer whose cost of capital is far lower. And we've seen some really just mind-boggling returns in terms of multiple in some of those situations. So it's something we'd like to see more of. So we get a shot at something in water across maintenance facilities, for example, something that would obviously be something you start out in private equity, but over time, guess what? Infrastructure, value add or opportunistic infrastructure buyers are big in that space. And so it's really created some good return potential. The one cautionary tone I would put around the secondary market right now is if you looked at really old private equity assets, ask yourself why they haven't been sold. How many times have they been taken to market and not executed? Yeah. And why? Because the concern is that a lot of these assets are actually mismarked because they're using relatively recent transactions that are around the best companies that are getting sold. And those that aren't the best, and maybe they have growth problems, or maybe they have margin problems, or they've been hit by COVID and then higher interest rates and something else has come along, tariffs, for example. And some of these companies have been disrupted and have just never recovered. And buying those assets at 70 cents on the dollar, you might find out that you are wickedly overpaying for them. So my suggestion is before you go out and decide to start calling up the brokers and saying you want to get into the business or see the next auction, I'd say spend some time with the folks that are in the trenches every day, and you'll find out exactly how complicated the analysis gets when the companies get old.
I would just say, when we were talking about discounts before, the point I was going to make is, even at very large discounts, you may be overpaying. And I think that is you have to be incredibly careful. So I wholeheartedly agree with that.
Yeah. We'll do rapid fire. We have a few minutes left. Your best dollar out. That could be an asset that you think is mispriced, an asset class that you think is mispriced. Anything goes. Alexis, we'll start with you.
So I'm sticking with secondaries then.
Yes, you have to stick with secondaries.
Look, we like markets that are kind of underserved, and I think there are still a few pockets within secondaries that are clearly not, efficient. I like, to think obviously that what we do at BEX is one of these pockets. But if I look at the rest of the market, I would think that if you have the right access within like middle market, for instance, I think you can probably make some great deals over there. And same goes for venture. We haven't spoken much about venture, but I think venture is all about access. So if you've had a long-standing relationship with some of the best GPs West Coast, and you see some secondaries happening there, you can probably make some great deals. It's a market where there's a huge stock of NAV, not much liquidity happening, and then the capital chasing that is so far quite limited. So I would think that there is kind of an imbalance between the offer and what's proposed, right? So pretty sure that there are some great opportunities in that space as well.
If you're taxable, go after oil and gas. It's really well priced, and the energy markets are very supportive right now. If I'm taxable and therefore got some different sensitivities, I'm probably going GP-led.
Mm-hmm. Taylor?
That doesn't leave much for me to say from a contrarian. We do all of these. I agree with all of that. I think we're finding very interesting opportunities in venture and growth just because of a sort of duration of the asset class that's extending there, but a lot of exciting things still happening, and investors need liquidity. I would say the same about middle market. I actually think some of the greatest kind of multiples we've created on specific assets and funds over the last couple of years have been in the energy and that space. Definitely, you have sellers for non-economic reasons there, and GP-led happen. Within the two deal types we're talking about, that happens to be the alpha generator today. Pricing is fairly efficient on the well-known buyout side of our market, but there are still, again, because we can buy the same thing from different people in different places who have different needs for liquidity, you can pick up excess return by buying from this sovereign here and not that pension there. And so it's kind of the whole world needs liquidity, so that's the nice backdrop for this market.
Yeah, I guess I'll be quick. I think just the ability for, on the GP-led side, or if you're with boutique managers, I think the ability to cherry pick and almost stock pick private companies and pick those specific companies that you want to have exposure to has never existed at this breadth and diversity and scale. So I think if you created a portfolio of basically cherry pick private companies, we've never had that ability at scale to do it. So any strategy that does that, I think, is an amazing opportunity, whether with amazing managers or yourselves. We've never been able to do that.
It's clearly, it's a growing space. There's a lot of different ways to access it. It's a very exciting time, and I think the future is bright. Thank you so much to iConnections, and I want a round of applause for our panelists today. Thank you so much.
Thank you.